the upturn in global equity markets over the month and weaker dollar can largely be attributed to looser financial conditions, with several federal funds interest rate cuts being priced from the middle of the year by market participants. However, we remain particularly cautious of this outcome, given the fact that the Federal Reserve's messaging has been consistent in articulating that interest rates will need to stay higher for longer, as well as the fact that they have expressed concerns over financial conditions loosening in the latest minutes. Also, we remain concerned over the tightness in the labour market and that economic demand will need to be quelled in order for inflation to reach 2% on a sustainable basis going forward. Other factors in terms of the expectation for liquidity going forward will likely need to be restrictive. So going forward, we expect the fact that the Treasury General Account will likely need to be replenished, which will likely be liquidity negative. And we do indeed believe that the Federal Reserve will keep interest rates higher for longer and continue to reduce their balance sheet, which we believe will withdraw liquidity as we head into 2023. It's also worth noting that the latest US GDP print was largely attributed to a buildup of private inventories. China continued to register a sharp recovery over the month, with several data releases surprising to the upside. This includes China GDP, retail sales, and industrial production beating Bloomberg consensus expectations and providing hope that 2023 will be a recovery year for China. Looking ahead, if we look at the high-frequency mobility data proxied by passenger volumes through the Beijing subway, those continue to improve significantly on a daily basis. If we look at a lot of the policy that has taken place so far, particularly from the monetary policy side of the equation, we see that much has been done to support the economy going forward. This includes cutting the reserve requirement ratio more recently, cutting of the 1 and 5 year loan key prime rates, as well as the fact that open market operations have been liquidity supportive for the Chinese economy. As we head into the new year, we think that the outlook for China will continue to improve with a sustainable reopening. However, we do remain cautious of further haphazard policy pronouncements and will be risk allocating accordingly. Other noteworthy events that occurred during the month include the rebound of the European stock market, buoyed by the China reopening, lower gas prices, as well as lower headline inflation. However, we do remain cautious of the European economy going forward, given that core inflation, stripping out your volatile components such as food and energy from the inflation basket, has registered all-time highs. Also, going forward, we will continue to monitor the high-frequency data, given that it is trundling at depressed levels and that the outlook of the European economy does remain lackluster at this juncture. Other noteworthy events that occurred during the month include the Bank of Japan record bond buying, where they have suppressed their yield curve in line with the yield curve control program band widening at the upper bound of 0.5%. This will be a close watch point for us going forward, given that debt to GDP ratios are well over 200% and the fact that the debt servicing costs might remain unsustainable if the yield curve control program starts to widen even further. Heading into 2023, we believe that central banks will continue to need to strike a fine balance between quelling economic demand to keep inflation at sustainable levels and making sure that the growth trajectory is still sustainable heading into the new year. We believe that the lagged effect of monetary policy will need to be assessed, particularly in the developed world, on the consumer and what the impact on growth and inflation will be.